Markets came to a grinding halt last week, with momentum pretty much dead and the NASDAQ showing a bearish divergence to the S&P 500. However, this Wednesday, Powell could bring the entire market right back to life at the FOMC press conference. We all know about the 25 basis point rate cut, that's old news, but the revival happens during the Q&A if Powell spends any amount of time emphasizing quantitative easing. Injecting liquidity into the system should send risk assets higher. For context, the reason this is important is the tightening cycle just ended this past Monday. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame talking about candle structure and location as we always do. In terms of structure last week, solid green-bodied bar with just a little bit of an upper wick and no lower wick. That'll become important in just a moment. The buyers closed fairly strong at the highs of the weekly range here, and speaking of weekly range, it was fairly small and compressed. If you were trading last week, you'll know that the daily chart was really balanced. There was plenty of two-sided trade chop and slop in both directions. So in my view, this is more indicative of price acceptance at these higher levels, basically an all-time high, equal high from off to our left. Now, why would I say that? Because on the bar-to-bar count, you can clearly see a bar-to-bar substantial higher low, and this is again why it's important that there's no lower wick. There was no price probing, there was no sell-side action that tested deeper into the Thanksgiving rally range. And instead, prices just remained elevated, and we technically made a slightly higher high, and we technically closed ever so slightly over the previous week's range. It's not like we were expanding range rapidly in the upward direction. Again, momentum kind of died out here, but it does seem like price acceptance higher. And if we just zoom out and think about the overall trend of the weekly timescale, it's absolutely in the upward direction. Remember that the pullback from the all-time high did technically yield a daily downtrend. And that means that this is the next weekly firm higher low in the trend count. So if we have a firm higher low and we've just come into an equal high, the next natural thing in an uptrend is higher lows and higher highs. So some sort of breakout here on Fed commentary perhaps from Wednesday, maybe just a natural bull flag breakout on the daily chart, which we'll look at in just a moment, seems very reasonable. There's nothing really for the bears to lean on here. If anyone's telling you that this needs to resolve as a double top, just understand that it's not going to be a double top until it is. It's a classic mantra here at the Trade Brigade. We would need to break down underneath the neckline, aka the last firm higher low, to actually bring in a lower low, which would then confirm some kind of trend reversal. And based on what we just talked about in terms of structure and location, doesn't really seem likely that the bears have any sort of major edge up here. So once again, weekly chart does appear bullish. We could come in and just remind ourselves with a Fibonacci that all of this is taking place over a Fib 38.2. This really just strikes me as bull flag consolidation from the weekly perspective, possibly ready to resolve in the upward direction. We could clear that up and take a look at the anchored view apps on the weekly. We're above the entirety of the stack, and once again, just put yourself in the shoes of a seller. Once you saw this breakdown bar on 1120 before the Thanksgiving rally, you really would have liked to see a lower high form on the weekly and some kind of rollover. It's just not taking place, and we're over that big quintuple bottom low at 654. On the weekly chart, there's no concerns as long as we're over 654, which will now act as, if we do roll over here, the neckline of the double top. But once again, bears don't have anything to lean on. I'll even take it one step further. Our last check-in on the weekly is the volume profile. And what do we see from this perspective? Did the bears close underneath the high volume node? Not even close. What about this high volume node? Technically, we closed above that. Let's take it on down to the daily time scale and let's see what's going on from this perspective. The first thing to check in on is the weekly expected move. If you're not familiar with this study, it's the gray shaded area right here. You can check out the video tutorial on how to set it up in the top right hand corner. If we're contained by the upper bound, the number is at 695.81, implying a higher high and a new all-time high. If we're contained by the lower bound, the number is at 675.57, and that of course implies a massive higher low. What I love about the lower edge of the weekly expected move is that it's not all that different from last week's lower edge, and it's right in the sweet spot. Right? If we're counting trend on the daily timescale, remember we had all-time high, we had a lower high, we had a lower high here, and we did make a lower low. Remember on that 1120 breakdown, this was a lower low. Now from there, we've got a V-shaped recovery, and we've also produced a higher high. We also have a higher high into the end of the week. And we do not have a daily higher low, a firm higher low at least. At best, and we talked about this on Wednesday, the bottom end of the multi-day balance range is a soft higher low. So even if this daily chart pulls back and breaks underneath the range low, I would still qualify this as a firm higher low in the trend count, confluence with the lower edge of the weekly expected move, daily 20 SMA in orange here, as well as the 50 SMA in blue, would be over the engulfer high from 1120 and over the engulfer high from 1010. So I still really love that 675 down to about 674 spot for that daily higher low. Now, let's talk about candle structure, because Friday's daily bar really doesn't look all that compelling, right? Throughout the week, it was defined by two-sided trade balance. And on Friday morning, there was a decent advance intraday. We'll take a look on the hourly chart in just a moment, but none of that action was sustained into the close. So ahead of the FOMC, it wouldn't be unreasonable that if you break down underneath 685 and fall back down into this balance range here, you could easily pull back into 679.50. And is that my favorite short? Probably not. Why is it not my favorite short? Because you're already flipping into a daily uptrend via these higher highs. I'm just looking for a higher low. So trading short into this balance range doesn't really strike me as a huge priority. Now, if the market breaks down underneath the balance range low, there's probably a short on the hourly time scale from A to B, in which case at point B, I would promptly change my tone and start seeking that daily higher low. Again, this is a scalp from A to B, and then from B back to, let's just say, C up here is the more meaningful trade to continue the daily trend in the upward direction if we do indeed find buyers at the daily 20, the daily 50, the sweet spot in terms of the engulfer highs, the lower edge of the weekly expected move. I mean, we've been going on and on and on about this level, right? It's very clear that 675 is critical. Let's come in with a daily fib before we go to the hourly from the bottom of this rally up to the top and just see where we land. Yeah, look at that. Fib 38.2 is right in the sweet spot as well. Looks beautiful from my perspective. Let's take it on down to the hourly chart now. Let's just kind of talk about this two-sided trade. We talked a little bit on Wednesday about the sellers failing to materialize from the broadening formation on Tuesday and failing on Wednesday to really make a meaningful move off of that Microsoft fake news headline about revising sales quotas for AI in the downward direction. That would be pretty bearish if you're generally skeptical about the AI trade, right? So none of that took place. Notice how on Thursday you get consolidation higher over the sort of dividing line of the hourly balance here. Then on Friday you also move higher. So the market's not moving in the downward direction. It is moving in the upward direction. It's just doing it very begrudgingly. So what does this mean in terms of tradable takeaways into the upcoming week? You probably shouldn't be buying breakouts. You shouldn't be buying high of days. You should be buying pullbacks. You should be trying to buy close to demand, close to support. So as this chart continues to move in the upward direction, what would be the most straightforward outcome? I mean, if this does fall down here, I mean, maybe we get some sort of left head, right shoulder, and you're just, again, do you want to be short here? Probably not. You might even entertain a buy side opportunity at 679.50. Do we bounce off of that and just remain range bound? If you could set up longs for risk reward back to the range high, maybe that's worth it. And then really the only short for the deeper pullback is, okay, let's get here. Let's maybe break down through the range. I really only want to short through the thin structure. So once again, as we talked about on the daily, that would be underneath 679.50 to get into this sweet spot pocket for the daily higher low. Now, when we get here, the hourly trend will by definition be down. You have highs, lower highs, potential lower highs here. And undoubtedly, I think the main point would just be to say that on the hourly chart, you absolutely have lows and you would have a lower low. So as the hourly trend flips to down, it qualifies this as a firm higher low from the daily perspective, and all we need is an hourly trend reversal back to the upside, and now we're in business. So I'd be trying to be a buyer at this zone down here still, right? In terms of upside, again, I've sort of talked about how the Friday daily bar doesn't really look great. You sort of failed that rally and closed fairly weak with the inverted hammer look on the daily. But undeniably, if you just consolidate here, you're building out another stair step in the upward direction. You could think of it like little Legos, right? Something like this, like this, like this. The next step would just be, can we Brigade bolt on maybe a more dovish and accommodative Fed on Wednesday into blue sky territories over 689? The engulfer range double, which still has not been hit, is up here around 695, which is close to the upper edge of the weekly expected move if this market does see continuation in the upward direction. So I'm taking it day by day. The market is clearly balanced. And once again, one of the things I would just reinforce, you probably don't want to be a breakout buyer unless the Fed offers a new catalyst on Wednesday. You probably want to look for pullback buys at key areas of support. There's really only one short in the market, which is going to be underneath 679.50. Let's take a look at the intraday anchored view apps just to see if this is going to align with anything we've been talking about, and lo and behold, the survey says yes. Look at the big cluster of anchored view apps here at the sweet spot pocket between about 675, 674, and if you anchor a view app to the breakout bar from over here, that was during the Thanksgiving week, you'll notice that once again, it really doesn't make sense to be short into that. Maybe you want to start thinking about the head and shoulders a little bit more meaningfully, left head, right shoulder here, if you drop that anchored view app, then that really activates this as a potential short. That's one possible interpretation, but if you're above 682.50, just think of it in terms of a building block in the upward direction. What I've just drawn in here actually is a look below and fail, and that's been a pretty lucrative pattern in the market over the last couple of days. If we look underneath the level, higher low reclaim intraday, you're probably talking about risk reward along these lines back to the all-time high. And once again, if the Fed catalyst does end up being more dovish and accommodative, you could think about that quantitative easing statement that we made earlier. If Jerome Powell acknowledges the liquidity flowing into the market, being supportive of that, then generally speaking, this on Wednesday or beyond could be the move to watch for. Brigade bolt into blue sky territories. If the catalyst supports it, once again, you do not want to be an all-time high breakout buyer if there's no catalyst. And we've seen that the market sort of fades from that. Look at Thursday's gap up, faded back down into range, right? Being a buyer of the high of day has not been lucrative over the last little bit. So that's kind of my thoughts on the S&P and how this market's trading recently. Some thoughts on the catalyst. Let's take a look at the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. We can see some subtle buying activity on primarily the Wednesday session, inflows there. Into the remainder of the week as the market was really sideways, you don't have anything meaningful in terms of volume flows. The advanced decline line is stuck at the 0 mark. The index score is really lackluster, as is the cumulative build on the tick. So not much to read into. If there was a big glaring bearish divergence at the exchange level, and oh my God, we have this secretive short the market into the ground, it's going to fail the all-time high, I'd let you know, but I'm just not seeing it. These internals are not bearish enough as we're going sideways for me to really feel as though, oh my goodness, this is like ring the alarm bell. It's not going to resolve well, right? It's really just balance until proven otherwise. And the daily chart still has that big opportunity for a higher low here, which I think a lot of people are looking for. Let's take a look over at the market profile and see what's going on from that perspective. Here it is. ES futures. If you're not familiar with this, by the way, market profile, check out the video tutorial in the top right-hand corner. What do we see in terms of value area, points of control? Look at how sideways the consolidation is, right? Even on the days where the market advanced a little bit, here on Friday in particular, value was like clinging to this bottom balance range with everything it had. And once again, we saw that in the upper wick of the daily candle, but just from a volume commitment perspective, I think this makes it even more clear. So until the market can substantially build out a value area for like a number of sessions and close it strong in that individual profile above the top end of the range, which I'll just go back to the spider's cash in a second, I'll show you the equivalent. If we can do that, then fine. Maybe again, it's more likely that we break and Brigade bolt into new highs on a positive Fed catalyst. But if this market comes back down into range, I just wouldn't force the issue. I would just let the market continue to grind around in this range, which is why I said just a moment ago, I'm not really thrilled about shorting in here. I would only really be thrilled about a short if we were to take out the bottom end of the balance, which if we just go back to the spider's cash over here, it's the same thing, right? It's this level right here at 679.50. Okay, and the top of the balance range that I would consider is this 685. In terms of if we go back over to market profile, got my command tab all messed up on Mac. It's this level right here, right around that 68.75 zone, if you will. Okay, and the bottom end of the balance range, it's really remained the same for quite a while now. It's just a hair north of 68.10, maybe like 68.12. Okay, so with that, let's move along. Let's take a peek back over at the platform here as I pause and get the NASDAQ all fired back up. Let's go to a weekly chart. There we go. Weekly chart here for the QQQ, and we'll take a peek at our trend. So in the intro, I said that there was no momentum. We clearly saw that on the intraday of the S&P, but I also said that there was a bearish divergence on the NASDAQ. And simply put, it's the lower high opportunity here. Now, what I want to point out, and I'll bring this up in just a moment, is there was also a lower high opportunity on the NASDAQ in this particular element when it was late to making a new all-time high before the S&P 500 did. And what I think you should pay attention to here is the XLF for the S&P 500. As long as the XLF looks good, there's really no issues in the S&P 500, remembering that it's the second heaviest weight sector now. But I digress. We'll talk more about the divergence in just a moment. You could see in terms of the weekly candle, it's a little bit better in terms of the range and the expansion to the upside. There's still that subtle upper wick. There is no lower wick, not much of a probe into the Thanksgiving range. You can clearly see on the bar-to-bar count higher lows, as well as a little bit more of a meaningful higher high and a more meaningful close above the previous week's range. So it's on its way, a little bit more range expansion here, but still nothing that I would say, wow, look at that. That's primed for a break into blue sky territories. If we were to do that, of course, we want to go with it because just like the S&P 500, we did achieve a daily downtrend in here. This is the last major higher low on the weekly trend count, and what should follow higher lows is higher highs. So Weekly trend remains up. We could come in with the Fibonacci's, the anchored VWAPs, the whole 9 yards. And what we'll see, of course, is that this is taking place over the Fib 38.2, bullish from that perspective. We could come in here with our weekly anchored VWAPs above the entirety of the stack here. We could come in here with our high volume node from the weekly volume profile. There it is. Let's take a peek. And we've closed over the high volume node yet again. What about this high volume node? We've closed right on it as of the Friday session. So a little bit of that bearish divergence. You do have this is the only thing that's somewhat different from the S&P 500, but for the most part, they're trying to move in sync lockstep back up towards those highs. Let's get it on down to the daily chart here. Let's just see what's going on with the QQQ expected move for the upcoming week's worth of trade. Notice that the upper edge of the weekly expected move is not forecasting a new all-time high. It's forecasting an equal high. Once again, subtle little bearish divergence with the cleaner lower high that's taking place here. That level, by the way, is at 637.73. The lower bound of the weekly expected move, though, is fantastic. It's the same thing as the S&P 500, a higher low attempt over the critical zone right in here, which is between about 613 and 611.50. It's also the moving average cluster, the 50 and the 20. It's the engulfer high. It's the engulfer high. So fairly straightforward there. Just like the S&P 500 on Friday, you'll notice that we form an inverted hammer. This is a little bit more important, though, because what this rejects is an overhead gap. We technically had a gap that was unfilled from the gap down back here when the downtrend started to kick off, and the buyers could not rotate number one all the way through the gap. They left a little bit of it unfilled, as you can see here in yellow. So that's warning shot number one. Momentum buyers really aren't kicking this thing into high gear. And then number two, we don't even close inside the gap range. We close back under the gap range. And as you can see and probably tell, if we take out Friday's low, it wouldn't be unreasonable for a range rotation into something like 618.50. Once again, like the S&P 500, that's not my favorite short. A better short would be looking underneath 618.50 into the critical spot here at 613. So that short from, let's say, A to point B might be available. And even that is a little bit more of a range-ish rotation than the S&P 500. An equivalent short might even be this to here. Now, on the daily timescale, I've been a bit of a proponent for this, especially in the morning preps at 8 o'clock Eastern. If you're not coming out to those, I would invite you to them. They're free here live on the channel every morning, 8 o'clock Eastern. But we've been talking about how 606 is really the equivalent to the NQ futures at 25K. And 25K is a great spot to still sustain a higher low in the trend count. Yes, it would be an overshoot of the picture perfect area, but it's still a higher low, and I would be a little bit more compelled for this higher low to continue the trend back higher as long as the S&P is over that 675, 674. So with the small divergence that we're seeing, once again, from here to here, it wouldn't be unreasonable that the NASDAQ might overshoot, require the higher low here, and then build something more structural up and over that 613 as the S&P 500 is coming into 675. Now, what I was talking about a moment ago in terms of using a comparison, you might remember, and this is sort of what immediately came out to me, was back here, the NASDAQ was also divergent. This lower high, whereas the S&P 500 had an equal high. I could show it to you in just a second as well. But the point of the exercise is to look at this action here and look at this action here. If we pull back and still find a higher low, heck, at this point, it was an equal low for all intents and purposes, and the S&P 500 is doing fine, I would not throw in the towel on the NASDAQ. Once again, give it that room into the 606. So this lower high ended up resolving higher. Another thing that you could read into here, and if you've made it to this point in the video, I thoroughly appreciate you spending the time to hopefully absorb all of the analysis. Let me know in the comments if you're at the NASDAQ divergence point. But the other thing to point out is the breadth. If the breadth was really narrow and oh my goodness, it's only NVIDIA rallying the market in the upward direction, then yes, this divergence is 100% a concern. But what have we seen over the last little bit? We've seen breadth expansion, right? Really, NVIDIA has been left in the dust for other new AI leaders. We've seen the Russell 2000 small caps explode in the upward direction. The RSP is trading well. And also, if I just go QQQE here for a second, we usually look at breadth later on. But look at this. Yeah, I mean, there's a subtle lower high, but it's much more of an equal high relative to what we just saw in the NASDAQ weighted, the QQQ regular, right? So all things considered, this is okay. I'm not overly concerned about the bearish divergence. Of course, I'm going to say it in the intro, right? Get everybody a little fired up. But in terms of how this is resolved in the past, it's really not that big of a deal. So you could look back at this August. You could do the same thing with the S&P 500. Let's look back at the August section. That would have been right around in here. And once again, notice how you've made it right back to the equal high, made it back to an equal high. You just really don't have anything to worry about. I shouldn't say you don't have anything to worry about, but I should say I wouldn't be overly concerned unless the breadth was alarmingly narrow, which it's not, right? Again, NVIDIA hasn't done anything over the last couple of weeks, and yet here we are in the market because this rally is broadening out. So that's sort of like my main thesis behind this consolidation, this price acceptance higher. So really talking a lot more about that on the SPY weekly chart that we just went through. But let's go back to the QQQ. Let's take a look at the hourly chart. Let's see what's going on over here. We'll come in with that same Fibonacci. I know we did it on the daily for the S&P, but I'll do this. There you have it, 38.2, right in the sweet spot pocket. If we clear that up, let's take a look over here. You're building blocks in the upward direction. Once again, it's not my favorite short on the NASDAQ to just short this into the range, nor even being a short into this range. The better short is this thin structure retracement here underneath the sweet spot to get into the still qualified daily high or low at 606, which is the equivalent of NQ 25,000. That's what we have there. Let's quickly check in on the anchored view app set and see what we've got from that perspective. So the cluster is supporting the idea and logic that this is still the right spot to look at, right? All I'm trying to reinforce by saying we can go here is that the daily trend will still have an opportunity for a higher low. It would be best, right? And I still think that there's enough supporting evidence to sort of confirm that this should be the ideal spot for the higher low to form. But once again, it's okay for a little bit of overshoot, especially in the NASDAQ. We know the NASDAQ overshoots quite a bit. You could see everything we talked about on the daily chart already with the look above and fail into the gap overhead. Might mean that this could be reasonable early on in the week, some sort of compression back into this range. If we do break down, again, I would really side more so with a short on the S&P 500 because there's more of that thin structure if we were to break down underneath this bottom end of the balance range to get this A to B trade that we've already talked about in quite a bit of detail. So that's my take between the two major indices. Let's go on over to the QQQ/NASDAQ side of the market internals. What do we see over here? Very flat, just like the S&P, flat and balanced on the tick. And again, like if you were going to expect a larger reversal of this trend, and oh my God, the market should be at zero, you probably are going to get a bearish build over here. You're going to get an advanced decline line that really falters. The volume flows will clearly be out of the market. You're just not getting any of that as the market's balanced to sideways in here. It looks more neutral. Like there's no hidden divergence at the exchange level. Let's get back on over to some market profile as well. Some market profile. Brain is moving too fast for the lips. What do we have over here? Same thing. So value area is unable to shift higher on that Friday session. We've got a 3-day balance range underneath us. If we drop into it, I mean, if you really want to play the nuanced short, if you want to try to play the range rotation from, let's just say, top of range A to bottom of range B, be my guest. But as I've said already, I think I've made it quite clear. I think the best short trade is really being patient for that ES to come back down into that thin structure pocket into the daily higher low, right? It's not really a bearish call. It's just like maybe the market pulls back. Let's get back on over and take a look at the IWM side of things, which of course is our good friend, the Rusty Russell. Let's bump it up to a weekly chart. Let's see what we have going on over here. I just realized I didn't take a look at the moving averages on the Qs weekly, but that's all right. We're above the 20, I'm assuming. Probably a safe assumption. Let's just go back over here, of course. Yes, there we go. Held it on the pullback. So IWM, cash ETF, equal highs, if not a very slight overshoot of the all-time high. We'll see that on the daily chart in just a moment. This looks bullish. This is a weekly high or low. There's really nothing to complain about here from a bull or bear perspective, like the bears don't have an edge and the bulls are doing fine type of deal. Much more of a volume inflow over here as the market continues to price in the Fed U-turn and the optimism that's there. We could come in from the last major low up to this high. This was a little bit more of an overshoot to the Fib 61.8, but we did end up holding that. That means at this point, if the weekly chart needs another higher low before breaking out, you could just find it over the Fib 38.2, which is now the weekly 20 SMA, as well as the bottom end of this balance range here around 237. So on the IWM, we've actually staged a 100% reversal, which is great in terms of this drawdown from here to here. And now if we need another higher low, there's room for it at a key reference point, once again, the weekly 20, as well as the Fib 38.2. Let's clear that up and take a look at the volume weighted average prices of the IWM. We're above the entirety of the stack, and once again, kind of have a little bit of clustering action happening here at the bottom end of this consolidation, which could yield the next weekly higher low for trend continuation. It's blue sky territories if we break out up and over this. Let's quickly take a look at our high volume nodes and see what we have from this point of view. Above everything, I would presume. Yes, and once again, a pullback can offer a higher low over these high volume node reference points. I could even do this. I could do this as the bottom end of the range. Once again, weekly has room for a higher low. This chart looks excellent, and really small caps are doing well based on, I would say, XBI and KRE, all responding to, once again, the Fed U-turn, which is one of the main components of the bull thesis as we've moved forward over the last couple of weeks. Expected move terms of weekly expected move. What do we see here? So 256.72 on the top side, and on the downside we have 244.82, higher high, brand new all-time high, and higher low, kind of an equal low to this pullback. A higher low, absolutely, in terms of the opportunity for a weekly, right? And really, the weekly higher low could be anywhere here. This is that weekly balance range we were just looking at. In terms of the Friday action, notice that we did not advance over the Thursday high, and instead we just backed off ever so slightly. I would think that consolidation here formulates a beautiful bull flag ahead of FOMC, and if Jerome Powell ends up being more dovish and does indicate, once again, quantitative easing, then guess what? Some kind of breakout here, totally warranted, right? If you're going to send liquidity into the system, small caps should be pretty responsive to that, especially as we think about the SEP. We'll get a new summary of economic projections as well on Wednesday at 2 p.m. If the market's going to become a little bit more concerning, I would really look for this to build out some kind of head and shoulders, right? We could sort of forecast a little bit of that action. Again, not trying, I'm not shorting the market here because I think this is going to happen. But if we see this, then fine. Underneath the neckline, right? This has been a straight up rally. I would imagine that there's plenty of room to pull back into that bottom end of the weekly range here at 241.65 to be a little bit more precise at the daily 20 SMA here. Let's take a look at the hourly chart, and you can see this, right? Really a straight up move. Hardly any consolidation, trying to be symmetrical on another leg higher this week. If this is going to yield that head and shoulders I was just talking about, that looks like this, and then you're talking about thin structure retracement into the origin of this breakdown bar. That's a possibility, but what should the primary possibility be? Well, if we just pull back, is this not a great spot for a higher low? Of course it is. Of course. So 248.25, higher low here. Risk, reward back to all-time highs, ballooning runners into blue sky territories. If you're like, no, I can't really buy that, then fine, let it turn into a bull flag, right? And then over the top end into blue sky territories, great. If Jerome Powell says the right sequence of words on Wednesday, you are in the clear for that 251.75 Brigade bolt into blue sky territories. Where I would really become concerned about the Russell is, let's just say Jerome Powell, as a final act of vengeance, which he's not that kind of guy, but let's just say he pulls something crazy out of left field for the Wednesday meeting. If he doesn't cut rates, not that it's his choice alone, it's a vote, but if he says things that are far more hawkish than the market's anticipating, this becomes the concern for the market. Anything underneath that 241.65 origin of the breakdown here is suddenly like, okay, why have we retraced 50% plus of this rally? Now with a hawkish Fed, or at least anticipated hawkish Fed, like what's going on here? That would become the concern if you lose 241.65 on the IWM small caps, which on the weekly chart would start to really signify more of an equal low opportunity rather than the higher low we were just talking about here. If we throw on the anchored view ups, and again, that's like really, really speculation heavy there. Jerome Powell's not, like I would think he's a pretty vanilla guy. He's going to keep it even keeled, and he's going to be, I would think, somewhat responsible there and just sort of like say data-dependent approach, what he always says, right? In terms of the VWAP cluster, it's all at that key spot in here, all set in terms of that 241.65, and also notice this anchored VWAP from the breakout day, or really, I suppose it's the breakout over these highs. There you go there. That is confluence now at this 248.25 for the possible higher low and continuation of the trend from that view right there. Let's come in with a Fibonacci from the bottom of the move up to the top, and then we'll come in with a shorter move as well. This 38.2 is not really confluence with the key spot. It's the 50% retracement. I'd say the 61.8 is doing a decent job of, providing confluence at the bearish engulfer high from 1120, but we've been so far over that high for a longer period of time versus the other index products, not overly worried about getting there, at least this week. If we come in with a fib from here up to here, 61.8 right on the money at that 248.25, just reinforcing that this is a pretty nice pullback opportunity on the hourly chart for small caps. Let's take a look at the Russell market internals and see what's going on from this view. Do we have any hidden divergences? Survey says no. One thing that you might read into, though, is just a little bit of that lackluster action on Thursday. On Thursday, the Russell did make a break in the upward direction. The advanced decline line did not really participate. Volume flows were not really that substantial, and the cumulative build was technically out on the Thursday session. So is it time for it to cool off a little bit ahead of the catalyst or upcoming, I should say, on Wednesday FOMC? It seems reasonable that the small caps may cool off here. I mean, we've made a heck of a recovery effort straight back into all-time highs. 100% retracement typically doesn't go through on the first test. It would be best if you got a higher low and then went through, or even a deeper higher low for the daily and then reattempted hourly consolidation and then go, right? So those kind of things are top of mind. If Fed comes out, if the Fed is overly dovish, again, I'm not going to fight this if it aligns with the fundamental catalyst happening at the same time. Let's get on over to the market profile for the Russell, just to be congruent over here. What do we see? Let's zoom this out a little bit. And what do we see? Really not much to talk about other than the same thing as we've seen elsewhere. Value area did not shift higher on Friday. It is possible that under Friday's low kicks off the pullback, and what we would be looking for is just to move back down into this 2505, 2500 flat on the RTY. I can't remember if we looked at the Russell or the NASDAQ or not. Yeah, we did. We were talking about the 3-day range happening here. So Rusty Russell, it's given us everything we need to know. We can see that things are slowing down. We can see that volume commitments are no longer at the tippity top. We do have, I would consider this a mechanical high. You should not have the end of an auction with two very precise highs there. You typically want to see some excess. So a higher low that comes back into these equal highs should yield a break on the first test, and we'll see if it yields excess or acceptance above. Excess meaning look above and fail, in which case that is not acceptance, or break, hold above, and then get a continuation move. If value closes over those two equal highs, that would be your indication that yes, market's trying to make an advance into blue sky territories. Let's get on over to our sectors and see what's going on with the S&P 500 from that view. Weekly performance of the sectors shows us that the SMH leads the pack here, up 4.46%, followed by the tech sector, up 3.44%, and then, of course, communications, 2.24%. The bottom end of the barrel, it's the utilities, 3.91. You can see healthcare at 2.41, and XLB materials down 1.23. There were some 2-to-1 splits on the sectors, so please be aware of that. I'll call them out as we go through. SMH here, I would say identical to the QQQ in some sense, where it is possible coming down underneath Friday's low offers a pullback, but there's really no reason to be an aggressive short here. I mean, maybe if you find a select setup in a semiconductor individual single name, that's fine, but this is kind of the next priority, to set a higher low over the moving average stack, over the bearish engulfer highs from, of course, 1010 and 1120. As long as we're over 350 on the SMH, I wouldn't be overly concerned, and as we know, new AI leaders are emerging. We've talked about this before, but Google, of course, had a great, or continues to have a great rally in the upward direction. INTC has done really well over the last little bit. We could see ASML making a new all-time high and consolidating above into the end of last week. And of course, AMAT is another one of the more recent winners, making that advance into new all-time highs as well. So as the semiconductor narrative stays alive, it's not like semiconductors are going away. It's just that NVIDIA is no longer the poster child. It's losing a little bit of its steam, and that's okay because rotation keeps a trend alive, right? So XLK looks good, or sorry, SMH looks pretty good. XLK also looks okay. I would say that it would be best to form a higher low over the moving average cluster if we were to pull back. This is one of the names that went for a 2-to-1 split. So the new level to watch is going to be at 143.75. If we could stay above that, things look pretty good. If we just drift in the upward direction, we have an unfilled gap above to potentially close as a target. That's 149 to 149.75. It would become more concerning in the XLK if we start to see this. I would say we're still okay here, but then any subsequent lower high that revisits an equal low, now you're talking about establishing a downtrend, now you're talking about establishing a breakdown point, and this, of course, is like the floodgates open back up, and it's not free and clear in the S&P 500. So watching that very closely, we don't want to speculate on that too much, just telling you what my sort of more concerning case would be if something like that does start to emerge. At least you could identify that it's kind of happening. But for now, this is absolutely more bullish, looking for that gap close overhead after a higher low anywhere over the moving average stack. Moving along to the XLC, I believe this was another one that split. Yes, no, maybe so. I'll have to find the PDF, and I think I posted it online. But anyways, you can see the equal high that's been produced here. Really strong move in the upward direction, primarily driven by, number one, the meta move that we saw, that meta, really the metaverse cancellation, if you will. And then Netflix, although it faded hard into the Friday close, it did have a very explosive move in the upward direction to start the day. And those gains seem to be solidified at the sector level here. If we're looking for next steps, ideally it's just a higher low over the consolidation highs, but this chart does look bullish. It is no longer in a downtrend. You do have higher highs. You've broken the downtrend line. You've broken out of this multi-day consolidation. For now, buyers have turned the tide in really all of the sectors we've looked at so far. If we look at the XLY, it's the same thing. We've turned the tide over here. Big drawdown, plenty of room for the market to suggest a lower high underneath. It simply didn't happen. Almost a 100% retracement to the high of the breakdown origin, and as of right now, consolidation here is bullish. Even this for a higher low is bullish on the weekly timescale. You could probably start to call it inverted head and shoulders, pie in the sky. And I would still offer up that this is the unresolved all-time high. Why do I say that? It's the improper end of the auction. There's no excess high. There's no euphoric high here on the XLY. I'm just thinking through the products in this, and of course it's your Amazon, but more importantly it's your Tesla. Is Tesla going to go on to produce this big all-time high breakout, sending the XLY higher into some sort of blow-off top? I mean, again, one can speculate. I'm not going to sit here and say that I'm positioned for that and right here, right now, I'm all bulled up on Tesla. It's not the case, but I'm just sort of thinking through the outcomes. I mean, if Tesla goes for this big high of day or all-time high break, it's probably going to send this, and does that yield the excess high? From there, do you get some sort of pullback and higher low above and trend continues? I mean, the chart doesn't look overly bearish here. As long as we can consolidate over 118, not bad. Looking for more upside on something that evolves into this. If we do get this, I would be a little cautious of the 118 possible lower high, right? This is like your bear case starts to emerge, but this would be base case for continuation higher. Let's keep going. Energy was one of the names that split here. I know that one for sure. Not really much to talk about on the XLE. Oil and gas tried to get in gear. I'd say that clean energy sort of had a little bit of a comeback. Oklo blowing up in the upward direction. I should maybe be careful with saying blowing up. It just made a nice move in the upward direction. We don't want to start to insinuate anything on nuclear, but XLE, I mean, a little bit of an inverted hammer here, pull back, higher low. It's such a lightweight component of the market. I'm not overly concerned with it. It's not hurting the market, at least. If we look at the XLI, I'd love to see a breakout here. Similar commentary to the XLY, where the all-time high is really the improper end of the auction. I would expect some sort of an excess high here, bullish 3-bar play forming on the daily chart. If we could get up and through it, maybe some sort of follow-through, that would be bullish for broad markets. If we just pull back to the midpoint, ideal next steps would be a higher low at the moving average stack. But, I mean, this has been so balanced for so long, I don't really think it's a big deal if it just remains balanced as long as we continue to see the XLF, speaking of, that's next, and the XLK doing well. So here's the XLF, and really this starts to just become a longer weekly balance, but in terms of the minutia of the day-to-day stuff, nice V-shaped recovery, sellers unable to yield a bear flag underneath that 52 spot here, nice higher low over the moving average stack, and continuation to a higher high. So in terms of the trend, it's all set. The XLF does look like it's got back-to-back inverted hammers, so underneath those lows, you're probably looking at another higher low attempt over 52.90. The big banks have really been helpful for this XLF recovery effort. What's not been helpful, so just as an example, you can go GS, behind the writing there, you could see that's trading at all-time highs. You could say C, Citibank, WFC, looks pretty good. JPM has been a little bit of a laggard. Morgan Stanley, even new all-time highs. What hasn't been helpful is your Visa, and what hasn't been helpful is your MasterCard here. So those two components, the payment processors, are weighing more so on the XLF, but the banks do look good. And what does that mean? In terms of big banks processing M&A fees and getting deals done on Wall Street, it's not typically going to see an uptick or improvement in a recession, right? That stuff starts to dial down. So XLF would be a bullish data point in my view. If we look at XLU pulling back, this is one of the lighter weight risk off sectors, so I'm not overly concerned. I know we didn't really talk about it, but risk on leads the way here. SMH, XLK, XLC. At the bottom end of the barrel, it's risk off. XLU, XLV, and XLB is the lightest weight sector there is. So I'm not really concerned from a posture perspective. XLU just pulling back through this thin structure. Possible to find a low here. It would be still a daily downtrend via lower highs and, of course, lower lows, but not really too much of a headwind for the market. I'm not going to look at this chart and say, wow, I mean, got to short the S&P 500. Utilities are breaking down. It doesn't work that way, right? Let's take a look at the XLV. This used to be the second heaviest weight sector, no longer. You can see it coming in from the all-time high. Pretty typical. I would think that on the weekly chart, this could easily fall into a little bit of an equilibrium, and ideally that would happen over this previous weekly pivot high at 150.25. If this could build out like this, I mean, what did I just draw? It's a pretty picture-perfect cup and handle, new advance into all-time highs. That would be the next leg, and that would really be when you want to focus on those XLV names, healthcare names, biotech names, drug makers, pharmaceuticals, medical robots, even ISRG comes to mind. Let's take a look at back at the daily, though. And let's just see what's going on. This is where I think it's do or die. Either you will continue this beautiful uptrend, leg 1, consolidation, leg 2, consolidation, leg 3. This could maybe yield a leg 4. But you've got to hold the 20. Otherwise, that's where I think you fall into that weekly equilibrium. You just go sideways for a little bit to digest this, and then you build some new pattern, some new setup, and then eventually over the top, right? So line in the sand, I would like to see 150.25, but really, as long as you're over this breakout point, I think we're doing okay on the XLV. Let's move along to XLB materials. I like to look below and fail, double bottom here, higher low for a Brigade bolt flag back in range. Technically should target the top end. Unfortunately, it's such a lightweight sector. I'm not going to read into it too much for the S&P 500. XLP, what do we have over here? Inverted head and shoulders with the opportunity to form. What you need to see here is a more meaningful recapture of this level at 80. If you could get back over 80 on the XLP, I would start to be a little bit more compelled in the upward direction. If we're thinking about some of the components in here, it's really cost that has been an issue and a drag on the XLP. If you look at something like, not W for Wayfair, but WMT for Walmart, on the other hand, this thing's screaming in the upward direction. If we look at XRT, which is the retail component of the XLP, this also has looked really strong strong recently. So XLP is a little bit of a shaky one. I would think that aside from Costco, perhaps, which does report earnings this week, by the way, it's very possible that, we could be on our way through an improved holiday season to something over 80. I mean, you see all these headlines that the consumer is getting absolutely crushed and, oh my God, this and everything's being financed. Well, got news for you. And as soon as anybody puts anything on a credit card, it's financed, right? So ignoring some of those Klarna reports and, Affirm reports, those buy now, pay laters, I mean, XRT is just telling us that there's spend. Go look at something like a Macy's, right? Breaking out to the upside. Look at a TJX. Look at a Kohl's, KSS. I mean, it's pulled back a little bit, but still a strong break in the upward direction. An Urban, URBN, as the ticker here. Nice gap in consolidation on earnings. I mean, there's just nothing that is another one, Rost, ROST, Ross Stores. Nice high and tight flag here. So nothing that's overly alarming. Oh my goodness, XLP won't possibly ever get back over 80. There's some components that are actually acting real nice. So thinking about that for XLP, and I get it. There's more to it than just that. We can go XLP here. And oh wow, no economic data. I'm on fundamentals, I thought. Let's go XLP. XLP, there you go. So Procter & Gamble, Coca-Cola, maybe more of those heavyweight components, Pepsi, Colgate. So, some of those names probably acting as a little bit more drag. Although Coca-Cola looked good on this breakout here. It looks like it couldn't sustain. Haven't looked in that chart in a little bit. Anyways, let's get back to the point. XLP, it's not going to sink the ship for the S&P 500. Let's go over to bonds. Nothing really to say on bonds. Maybe Head and Shoulders starting to break down. I wouldn't do much with this until we have FOMC out of the way. If this gaps down on FOMC, which that would really be a surprise from Powell, I think. But if this does gap down, maybe there's some put sales that exist under 85 if the implied volatility can really ratchet up and make it worth our time. If not, I would just kind of let this be building out a higher block, right? Block 1, block 2, and probably it's actually just a long over 88.25, right? Just a big old retest over the 200 SMA and the top end of this prior range. I do understand the threat, of course, of the lower high, but I mean, if the Fed's going to be lowering rates, it's going to be all up to those bond vigilantes who say no to Hassett being Fed chair to sell this thing off on the long end of the curve. Let's take a look over at the real estate sector. Really, nothing has been going on here for 7 months. I'll save you the time. Let's take a look over at our market sectors related to the S&P in terms of the ratio grid. If you're not familiar with the ratios, check out the video tutorial in the top right-hand corner. XLK, subtle signs of improvement, trying to get back over a 50 SMA. I'll give it the benefit of the doubt. XLF, nice sideways action. I want to see it perk up in a more meaningful way. And again, it's probably going to take the payment processors to straighten that out. If we look at the XLY, I like the advance, but like the XLK, it's probably got to get up and through the 50 SMA for me to put a firm check mark here. I'll go neutral. XLC looks okay. It's breaking through the 50 SMA. It does have a nice breakout look rather than just sideways, so I'll give a check mark there. We don't have risk off on the XLP nor the XLU, and the XLV is kind of a bit more neutral here, remembering that it is heavy-ish weight. It's not a lightweight, oh my god, risk off. If XLV is performing well, we're going to zero. And not really the situation, right? So as of this picture, leaning towards trying to reinitiate risk on, but we're not fully there yet. You can see the same picture if you look at the A set of the specialized set. Trying, this is really more of a volatile range than anything else. This is like a little bit better, not as good as those top two. This is like we're not there yet, and this is like we're not there yet either. So, trying to reinitiate risk on, but not fully on board yet. I think that we could be optimistic and open-minded to it. If we look at these ratios, so gold kind of sideways relative to the S&P, what I think this starts to represent as you go more sideways in here, it's actually an indication that the gold is being traded more so by speculators rather than people who are jumping into it as a defensive hedge, right? This was like, oh my goodness, defensive hedge. Now that we've put in that top, it's less about defensive hedge, it seems at least, and it's more about, people just trading this as a one-to-one basically with the market as this goes sideways in the actual ratio. Kind of like a momentum trade, if you will. The TLT ratio did make a new high, so that screams healthy for risk appetite. Again, it's one data point through everything we've looked at thus far, so I wouldn't go full bore risk on, I think for good reason that we've looked at thus far. Bitcoin trying to make a stand here, an arbitrary high or low. It's kind of along these lines. It's not exact, it's not precise. It does have the look of a daily double bottom. If I zoom in over here, this at least was your double bottom. Trying to break it. This trend line just needs to hold a higher low, and maybe we'll remain a little bit more bullish and optimistic. But for now, it's still, and maybe this is an unpopular take, but it's still just a bear flag in the context of a breakdown here. So I'm not fully sold on Bitcoin yet, turning into a risk-on signal. Let's jump into the dollar and rates. You can see that the dollar really hasn't done much here other than fade off of these highs. So, it's like, I think the dollar probably moves lower if Powell comments at all about this sort of injection of liquidity. And I guess that really just brings us to our fundamental conversation. If you notice that long end rates are trying to break out here, that's that TLT moving down underneath the 88 handle as well, then it's the bond vigilantes stepping up and saying, like, no, we're going to demand higher rates on the long end if we think the Fed's going to run the economy red hot with the replacement of Powell for Hassett, who maybe bends the knee and cuts rates a little bit more aggressively than the data might suggest. So that's kind of the take here as the 10-year tries to move higher into a rate cut and the dollar moves lower. If you take a look over at the inverted ZT, we know that the odds of the 25 basis point rate cut have remained the same. So let's just jump over there now and we'll put our fundamentalist hats on. Come on, click for me. There we go. Fed Watch tool, what do we see over here? So about 86.2% chance of a 25 basis point rate cut, and that's kind of unchanged through last week. Once we got the confirmation from Williams, Waller, Hassett commented on it. A number of Fed commentators really came out and said, yeah, it seems more reasonable that based on labor we might cut rates, right? So why is that possible? Well, if you take a look through some of the data we got last week, or like why would we reinforce that that's probably what's going to be happening? Look at the employment situation here. Actual versus prior on manufacturing actually saw a downtick and was a big miss from the forecast. You could see if we're thinking about inflation, prices paid, only a minor uptick there, 58.5 versus prior at 58. And I understand that, yes, directionally over 50 is still an increase, right? It's not like it's sub 50. You could take a look, though, at things like if we take a look at ADP employment, big miss over here, so concerns about the labor situation. If you look at the ISM services employment side, you could see a 48.9. That is just a hair better than prior, but once again, still sub 50 would indicate a contraction on employment overall. If we look at prices paid, inflation seemingly not as big of a deal. Again, still hot numbers over 50, but directionally, look at where it is relative to the prior 70 and the forecast at 70.3. So progress made on that front. If you scroll down even further to our PCE from Friday, this is old data. This is September's information, but you could see the actual came in on par with prior, 0.2. It's pretty reasonable for a PCE inflation read. And more importantly, if you look at the Michigan 5-year inflation expectations, 3.2 under the 3.4, and I honestly saw expectations of about a 4.5 on previous. I can't remember exactly where that point was coming from. I'll find the news article and maybe clip it into this video here, but it beats expectations, and it's underneath prior. So the main picture I'm trying to paint here for you is that inflation is not really as bad as maybe people were worried about. Some of those Fed commentators who did say something about inflation, mainly looking at like Lisa Cook and some others really early in the week before Thanksgiving, right? So not as bad there on the inflation front. And then employment, just kind of along the lines of what the Fed is expecting, it is certainly softening there with some deceleration in some of these data points that we've looked at. If the next thing we should care about is what the Fed does, it should probably be the forecast for 2026, right? As of right now, their latest SEP, which was September, does outline a 3.4 for the calendar year of 2026. You probably want to see that match the Fed Watch tool here at least a 3.1, if not slightly lower than that, maybe a 2.8. 2.8 would really indicate that, yes, the Fed is thinking more aggressively about substantial cuts into the future to be more accommodative and ensure that we don't drift into a labor-induced recession. So if you're leaning more dovish, those are the things you want to pay attention to. Once again, on the SEP, you want this number right here to really fall to something like a 2.8, at bare minimum a 3.1, right? What else can we say? You'll probably want to look for some sort of consensus in dot plot here. I think what will maybe ruffle some feathers is a non-consensus and many dissents. Remember, at the last meeting, we did have some dissent from Mirren, as well as, I'm going to blank on who it was, but there was another dissent on both sides, basically, from the FOMC decision last go-around. So we'll see how this dot plot emerges. Is there really this big bifurcation in terms of a bunch of people who want higher rates and ensure that inflation doesn't come back? Or is it, down here with a bunch of people voting for lower rates and being accommodative to labor? It's just really important. And by the way, we will be streaming this live on Wednesday at the 2 o'clock time frame. So I would encourage you, if your head is spinning and you're like, gosh, I can't keep all these data points straight, we'll be covering it live on Wednesday at 2 o'clock. We'll probably start at 1:45. In terms of data points ahead of the FOMC, we will be getting the JOLTS job openings. This is old data to be released. You can see September here. So we'll watch to see how that indicates anything for the employment situation. You'll also notice that this is just the main event. And then into the end of the week, it's pretty standard stuff with jobless claims and then some Fed speakers to follow up after the decision has been ultimately made. That's what we've got there. One thing to just point out for anybody who's maybe curious about the commentary about the brain. The intro, we said the injection of liquidity based on quantitative easing, right? You can find a number of these graphics everywhere, but quantitative easing is injecting liquidity to the Fed balance sheet. Typically, the market moves up. When you can see the stagnation, you can see the stagnation. When you can see the deceleration, you can see the volatility, right? This, of course, is the sickness. Inject and print a bunch of cash. Market does what? Rips in the upward direction. Announcement of QT. Market really struggles through 2022, right? So just pointing out that this is a big deal. It's not just like, oh, let's watch for QT, QE. Like the market does respond quite literally to liquidity situations or conditions, I should say, and any commentary from Powell will be scrutinized with a fine-tooth comb on that Wednesday session. Earnings calendar upcoming this week. What do we have? Some pretty big names in terms of data center. I'm primarily concerned about Oracle here. Broadcom on the semiconductor front, absolutely. Ciena will be interesting from an optical computing perspective. What else is in here that captures my attention? Maybe Adobe, one of the long-lost sort of traders there. Now we have Figma, of course, as an IPO. Costco, there it is, and maybe Restoration Hardware. That's always a fun one, at least that I like to watch in terms of an indication for the more affluent side of spend. Are they feeling a tightened budget, or are things going fine into the holiday season? That's really what we've got on the earnings calendar that'll move the market. Maybe get out your popcorn if you'd like for something like a GameStop on Tuesday after the close. In terms of what's been happening with the earnings, I just want to point out here, Q4 earnings are not expected to do anything substantial. Where you really start to see the retracement is, look at this bump. Right now, what does this coincide with? Let's think about this for a moment. This coincides with a Fed U-turn, right? This bump right here for really calendar year 26 EPS expectations is aligned with when we got the U-turn from Williams and then Waller. It was really, let's just say W squared. Williams and Waller. They both came out, said, yep, 25 basis point cut. Forget about what all of our other colleagues said. Hassett then came out, and you could see the revision higher in the EPS for CY 26, calendar year 26. And therefore, right, we're probably not expecting anything major for the next earnings cycle. Why do I bring this up? If you see disappointing earnings, we're just got through earnings season, but as we approach the next earnings season, if you see disappointing numbers, the market's not pricing that in. The market's pricing in the entire calendar year of 26. I mean, look at how straightforward that correlation is. Boom and boom, off to the races. What does that align with? W squared, right? Fed easing, Fed U-turn, injection of liquidity, right? All set. So just wanted to point that out. The other thing to point out, if I scroll up on this report, is the number of times that earnings calls are citing AI. Now, of course, we don't know the context of whether or not this is more pessimistic or optimistic, and you could probably fire that up in a Bloomberg terminal and get a little bit more specific, but at least in this report, the mentions of AI have only increased ever since the ChatGPT moment. We're sitting at an all-time high record of 306 mentions in AI earnings calls, or just earnings calls of AI, I should say. Just like being a naysayer of AI, I think misses the point here, and being a pessimist about AI not reshaping the economy, it's in the data. How could you look at this chart and say otherwise, right? So it's coming, and if you're not using AI, if you're not experimenting with it a little bit, I mean, not even for like investing, but just like day-to-day tasks, right? Using it as a search engine, basically. Then, why not? Why not? It's a thing of the future. These companies are talking about it. These are big money companies. This is not just like mom and pop shop down the road invented this thing, right? And, I don't even have to bother telling you this. So let's just move on back to the platform and take a look. Don't be an AI naysayer is basically what my point is. Let's jump into the bond ratios, and all this would indicate is, again, a little bit of concern about running the economy hot. If we do get Hassett as a Fed chair, expect this thing to rocket off the roof, and ultimately the long end of the curve will move substantially higher, even if they're going to try to control the short end on the 2-year or below. Let's take a peek over at something like the credit spreads here, and you can see that we are becoming a little bit less volatile here as this moves underneath the 50 SMA. That is bullish for risk appetite. Let's jump into the HYG. Little bit of a divergence here. If I bring this up, you could see we have this higher high versus this lower high. I think that this aligns with what we're seeing in the market, right? We've seen chop and slop. We've seen balance. We've seen a really reluctant tape to move in the upward direction. You can see junk bonds aren't really confirming. So no real issues there. Continue to pay attention to this thing intraday. It's been incredibly helpful. Let's take a look over at total breadth. Breadth is a non-issue. So remember on the QQQ, as I was sort of trying to clarify my thoughts there about the previous August divergence and being sort of in a similar position with the S&P equal high, NASDAQ lower high, breadth is fine. If breadth was still down here, right, and oh my goodness, new highs versus lows is still clocking a negative 100, then yeah, I'm definitely concerned about the NASDAQ lower high, but it's just not. Breadth is doing okay. Improvement on breadth, if anything. You can take a look at some better versions of the RSP here, throw that front and center, notice that you made a new high. RSP looks pretty darn good. The broad market rally is indeed broadening out. Let's take a look at the QQQE. I know we looked at it a little bit already, but what do we see here? Once again, a better high versus the lower high that's been made on the NASDAQ weighted. Let's jump into our volatility indications. Volatility is compressing, confirming what we saw in the junk bond versus government-backed, aka a proxy for a credit spread. If we take a look at VVIX, volatility of volatility, still has some room to fall. 75 is typically a place where you don't stay too long, so I honestly don't think that the VVIX is going to move much lower, but stagnation here would just be bullish as long as we go sideways, right? Let's take a peek over at vol futures. Really deep contango starting to emerge. That's bullish for risk managers allocating capital. Same thing here on the 30 versus the 9-day, and the 1-day VIX also sitting on these lows. I do want to bring up the skew. We haven't talked about it in a long time. It's kind of unchanged. It just would, to me, indicate that not everybody is reaching out for insurance, so to speak, forecasting a black swan like we were headed into the early stages of 2025. Which brings me to my next point. If we go to something like the P-call, put-call ratio, we just came off of a very extended read, and I'll just hover my cursor here. Let me maybe try to align these charts a little bit better. Do something that looks like this. There we go. Extended reads over 1 typically coincide with bottoms. Notice this, right? There's your bottom. If we do this, it's not over 1, but you get the idea. It's very close to a bottom here. This even starts to mark a little bit of a bottom. So when the what would you say? There's such a great imbalance between puts and calls in the system, right? Typically, it starts to tell you everything you need to know. So P call over 1 coming back down, right? Now we're starting to get a little bit of lift, which once again might align with the bullish thesis on the weekly chart that an equal high breakout should just yield higher highs and continuation of the uptrend that we're working with. That's what we've got through the supporting evidence categories. Let's take a rip through the core list of companies. Then I've got 3 additional trade ideas for you. NVIDIA has really taken a backseat to this market, although it is getting tight as of Friday's close. Look at how it's underneath this breakout point, and look at how tight this consolidation has become right up against the daily 20 SMA in orange there. I would love to see consolidation in an intraday Brigade bolt over 184.75 for a classic look below and fail. This has been all over the place recently. AAPL, these are not the additional trade ideas, by the way. I'm just showing you some things where this has worked. Look at this, right? Undercut and rally of this prior low. Gets really tight in here. Over the previous breakout point, boom, breaks out, right? Go over to something like an IONQ. This one's probably a better proxy as a back-to-back with NVIDIA just because it has this previous breakout level, right? Look at the big previous breakout level. It looks below it. It fails to find sellers under the 200, and boom, on Thursday, it's massively higher. So for NVIDIA, it's the same look, right? You can see how this chart is the same kind of idea. Can we get back up and over that 184.75? You know, that's the question to ask and answer. If we see consolidation and a Brigade bolt above with momentum, pair it with a catalyst, and, you know, I have no idea what that catalyst may be. If you're, you know, an NVIDIA follower, maybe you have an idea. But if we do see something in the headlines at 8:30, 9 o'clock ahead of the market open about AI, semiconductors, chips, NVIDIA, and we start to get this break, yeah, of course I'm looking for that. Thin structure retracement off to the left, and it's sort of right along the lines of the pattern that's been working really, really well in this market. So Brigade bolt over 184.75, thin structure retracement. Do mind the daily 50 SMA in blue here. If it doesn't break, if it's just, you know, noodling around in here, stay away. There's no need to get involved if it's just doing this. No reason to get involved. Let's move along. Apple. What do we see? Beautiful pullback. I love this. I love Apple pulling back over the previous balance range that it broke out of. I would love to see if we can stage a reversal here over the daily 20. FYI, I did start to add some swing shares position into the end of Friday, or it was really the morning on Friday. So in a little bit of drawdown on that, but willing to add again if we could build some kind of higher low in here at the previous all-time high 277. As long as we're over that, I'd like to basically target a reclaim back to the all-time high and continuation into blue sky territories, continuing the nice daily trend that we have underneath us here. If it just noodles around in here, may cut it underneath the daily 20, we shall see. That's one step at a time. I think the risk reward is worth it. Microsoft, another one I have a swing shares position on off of this, and so far so good. I actually really like the Friday session perking back up. It had an opportunity to move and just stay inside of Thursday's range. It didn't. It closed back on the highs of its range on Friday, and now we have this gap to close overhead, potentially a move to here, and what does that do? Starts to stage your double bottom. Now, I'm not oblivious to the fact that this is still an H pattern until proven otherwise. If it breaks the multi-day range low, then of course, daily 200 retest and probably stopping out underneath the weekly prior high. That's at 468. If we go to the weekly chart here, all I want to point out is the reason I think this risk reward is worth it is because you have this previous high acting as support, risk, reward, right? Really back to the highs. And it would be best if we can clear through the rock and a hard place. If this is a rock, your hard place is right here, the double top neckline. Again, not oblivious to these things. If we can get above, that's where we're looking for upside. So I really like that on Microsoft still on the daily chart. I like the Friday close. Ideally, right, shaking off that headline from the Wednesday morning session should, I think, provide some opportunity to get back up into here. And then ideally, the next move for continuation as a trade is over that double top neckline. 493 is the number to beat. If you take a look at the hourly chart, there's really not much to glean here. Still overhead supply, yes, not, again, oblivious to any of this stuff. I'm aware of the risks of this trade, and that's just the way I see the chart. Possibility of a higher low, staying over the daily 200 SMA. If you're not going to take a shot on Microsoft, the daily 200, when are you going to buy it? Chasing it at the highs? Same thing on Amazon. Long from down here still, added to it on, Thursday, and willing to look for another higher low. So still sitting pretty in this one. And in terms of the daily bar, little inside candle there on Friday, I'd like to see some resolution. It could really resolve two ways. If I'm going to favor bull side, I'd like to see undercut and rally here, look below and fail, basically 227. Inverted head and shoulders is fine. Or just inside candle break, reclaim the 20, and make an equal high after a higher low. Then I'm looking for a breakout into here, right? That is the upside. If it's going to resolve downside, then fine. Like, this is bearish, undoubtedly. Failing the daily 50, getting acceptance under 227, yeah, bearish, right? So we will have to adjust the position accordingly if that does end up taking place. But for now, that is Nancy. Let's take a look at Google. Google, another one that looks pretty solid like Apple. You can see we went look below and fail on the 3-day balance range here, closing slightly higher on Friday, but it's really struggled. It's really struggled there, especially with that Thursday gap up that failed right back down to the lows. So a little iffy. I'd like to see some consolidation. Google could be the play on a Brigade bolt to get to the all-time high from the overnight session at 333. Leaves a little bit to be desired, and if it does pull back, I would also entertain this. Been more of a proponent, more so on the lookout for a Google higher low over the daily 20 if it does break down, and if it does fail as kind of a lower high here, break this, maybe you have a little bit of a double top, right, under the neckline. I don't want to short that. I want to be looking for the long here at the gap fill reversal and the daily 20. Let's move along to Broadcom. AVGO, great look here, great little opportunity on Friday with a look below and fail on the morning low after gapping up. Nonetheless, breaking out of two hammers from Wednesday and Thursday as a higher low relative to here. So range expansion happening, higher low, pre-earnings run-up. I probably am not going to be interested in trading this one at all this week unless maybe shares offer a lucrative opportunity early on. Consolidation over 368.50. And then a follow through up to the all-time high looks decent, and then just Brigade bolt is pretty straightforward to blue sky territories. I would absolutely change my tone on this if it fails the 372.25 and comes back down into the range here, into the moving average cluster. Not interested in the midpoint. If you can establish a short here for some kind of look above and fail, maybe it's a lower high double top, maybe that's the neckline. So 372.25, the key component to really see from that. Let's go with Meta. Meta on the gap up with the cancellation of the metaverse on Thursday morning. Nice inside candle, and honestly, there was a pretty decent intraday opportunity. I looked back at this, and I was a little stunned that I missed it. Reason being is probably the 200 and the 50 were just keeping me away from the chart in general. But look at this beautiful intraday Brigade bolt here off of that 668.50. So trading quite well in terms of respecting the levels. Let's go back to the hourly chart. In terms of next steps, right, consolidation that gets over and into the earnings gap above, that would be the compelling long, or a gap fill reversal here off of the 648.75 is another place that I would look for. It does seem likely to me that Meta, after a 100% retracement, especially gapping up on that Thursday session, could easily use some phase of consolidation or a pullback to close the gap, repair the structure, establish a better daily higher low, and then try to make an advance into this overhead gap from the earnings cycle back a couple of weeks ago now. Let's move into Tesla. Tesla, we did a little bit of speculation on about possibly breaking out into blue sky territories, fueling the XLY higher. And you can kind of see why, right? This chart looks very similar to the XLY. A little bit of an inverted hammer on that Friday session, a nice breakout from this little range here, pinched between the moving averages. I'm curious to see if this can find a higher low over 441.25, origin of the breakdown here from this overhead balance. If it can, great. This is really starting to stage a look for a potential flat top base breakout over something like 470.75. Again, don't jump the gun here, but if it does this, builds out right side of the base, great. That would be the next step, and I'm sure everybody and their brother's mother sister will be talking about that potential setup. If we move under 441.25, still a chance for a higher low in here. It's probably just a little bit sloppy. So I wouldn't be thrilled about trying to buy it, but I would still just remain open-minded to finding a look below and fail. Higher low needs to be here, and then some sort of rotation at some point in the future builds out a better base to participate in. Let's move on over to JP Morgan. Back-to-back upper wicks there off the all-time high, previous all-time high rejection point. We talked about CWS FC, we talked about Goldman Sachs, all the big banks so far. So JP Morgan's the laggard. If it does pull back, you can find a higher low here at 309. That would be ideal. Really, you want to build out new acceptance in this range, and then ultimately Brigade Bolt, perhaps ahead of earnings, which is crazy to think about. Earnings, it feels like it just ended, but we will come into a new cycle here as soon as it looks like the 12th of January, maybe the 13th. 13th is when banks kick off the next earnings cycle. So moving along, let's go to Palantir. What do we see? It has recovered the bottom end of the juncture. Again, I have to give credit where credit is due. I was thinking lower high underneath, huge overhead supply, but Palantir Army is strong apparently. So what are we looking at now? Possible higher low to confirm it. I'm not really interested in chopping around or trading in this chop and slop. I know some of the moves intraday have been fairly clean in terms of at least this grind here on, what was that, Wednesday? So I get it. There's some movement going on in Palantir, but it's really not my favorite location to be trading this in the midpoint of this range. So I'd like to either see something very clean, a higher low here that is undeniable with an intraday setup, fine, risk reward back to the top of the range, or just like build this out, do whatever. Maybe it's not very easy to capture, but then this really gets it back in gear when and if we can break out over 187.25. So leaving a bit to be desired here on Palantir in terms of new trade ideas, just not really seeing it clearly. AMD is another one of these situations where technically I still, I'm bullish on semis, but AMD doesn't really look good, neither does NVIDIA. If you take a look at where it's rejecting, it's the key moving averages as well as the overhead supply from here. What I find quite compelling about this is if you take a look at the hourly chart, look above and fail on this little range, right? So now this is a little bit of a double top, and this, of course, will become your neckline. The short didn't really work too well on, what would that have been, Wednesday or Tuesday? I'm losing track of my days, but the short didn't work well there, but maybe it'll work well now that you have two failures to accelerate over the moving average stack. AMD looks more like a short, but the broad market's trying to remain bullish. So a little bit of tension there, a little bit of push-pull. I do think that this would be the opportunity to look for. It's a thin structure retracement here, but you probably want alignment with the broad market. You probably want the S&P pulling back. You probably want the NASDAQ at least testing that key support area on the daily chart, right? And if that's happening and the NASDAQ catches a bid, probably don't want to be short at that exact moment. You probably want to be through that on the NASDAQ if you're looking for AMD short here into the top end of the gap. Anyways, let's move along to Robinhood to finish up the core list, and then we've got 3 additional ideas. What do we see on Hood? Let's go to a daily. Daily chart honestly doesn't look bad. You've reclaimed the neckline of the double top, 1 and 2. You could see Brigade Bolt, happening here, there we go, at the neckline level. That was this session. And now you've really advanced out of a 4-day balance range. So Wednesday, clean breakout and a clean pullback here on Friday. As long as we're over 129.25, that looks pretty darn good to establish the higher low and get risk reward in the upward direction, or follow through like this to ultimately rotate back up through this range. That's over 137.10. Here it is on the hourly time scale, and again, a very clean trend. Something that looks like this, trying to use previous resistance as newfound support on Robinhood, 129.25 looks pretty darn good. So trying to position in here for some kind of long opportunity back to the top or even a breakout into this next overhead range off to the left. 3 additional ideas and then we're out of here. TGT, what do we have on target? It's in a horrible trend. Let me firstly point out and acknowledge the daily 200. Horrible, horrible trend. However, is it trying to build out a little bit of a reversal? Maybe. It's getting tight here. What do we know about the retail theme? Is the XRT doing well? Yes. Is Walmart doing well? Yes. Target is clearly the laggard. If there's a catch-up play to be had, maybe it's Target. So putting the pieces of the puzzle together, it's not just blindly buy Target. It's does the Fed accommodate the market via more liquidity? Talking about quantitative easing. Does the Fed talk about 50 basis point cuts? Does the Fed talk about cutting deeper into the 2026 calendar year? If so, and retail continues to look good, maybe there's a catch-up trade here. It's not like this, oh my God, let's invest in Target. It's, not really, I wouldn't do it at least with a daily 200 that looks like that. But there could be a trade here through this thin structure retracement is the point I'm getting at, with some of its cohort performing quite well. TJ Maxx, Walmart, and then Target here not really doing all that great. Again, look at Macy's, look at Kohl's. So that's Target as a long idea. Over 93.15 as a possible scalp up towards this 98.75 daily 200 SMA. Thin structure retracement to the left. Next up, Circle. Another one. Let's acknowledge. Clear downtrend happening here. If crypto's going to find a little bit of a bottom, and we are starting to see a little bit more conversation about tokenization and things going on chain, then is Circle not a beneficiary of that? I think it is. So as this reclaims the daily 20 SMA, little hammer candle there on Friday, over this high could come up and close the gap. Are we talking about a groundbreaking trade? No, and I mean, it doesn't look like much in the context of what's happened here, but don't forget, I mean, we're talking about a move from 87.50 to nearly 100, a 10% move. Is it possible Circle has a 10-12% day on a breakout? Yeah, of course it is. Look at this. Look at this, right? Look at the down moves. Look at this breakout over here, right? Circle can travel this type of range. It's a high beta name here that can have a 13% day. So I think it's worth watching over 87.55 as long as it's holding over 81.20. Here it is on the hourly chart, and you can see the reclaim. It's not like it struggled at all at the daily 20. It actually held above quite cleanly. As long as we stay above, that's kind of the next step in the upward direction. So that's Circle, idea number 2. And then last, we have PSTG. Pure Storage just reported earnings, got whacked, and it's actually looking bearish. So if the broad market falls apart, if we don't need long ideas and we don't want to fish for Target or Circle, then guess what? You've got a bear flag here, bearish 3-bar play, now a 4-bar play with the inside candles from Thursday and Friday. If this takes out the low, I would target the daily 200 in here at 64.56, and then the earnings gap closed from now 2 cycles ago at 61.15. Pure Storage does not look too pure. I would kind of stay away from it on the long side. I wouldn't go bottom fishing here, and it does look like momentum may continue to the downside if we start to drop 68.35. It's not in play if you really start to squeeze and pinch up and over 72.20. So the parameters of this trade to keep it in play, stay in the flag, stay nice, and then downside. If it starts to pinch, you have thin structure retracement, you may get a Stevie Wonder trade. I wouldn't try to buy that. I would just avoid shorting it. Okay, that's Pure Storage, and that's the final component of today's episode of the weekly watch list. So if you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember, we're live every single morning at 8 o'clock Eastern time for installations of the pre-market prep, where we build a real-time game plan for whatever the market has in store for us that morning. Again, 8 a.m. Eastern to about 9:20. So I hope to see you there. We will be live streaming the Fed this week. That's Wednesday at the 2 o'clock time frame, so we'll probably start at 1:45. Give some folks some time to trickle on into the office. We'll do a little recap of what's been going on for that day thus far, and we'll sort of prepare for what Jerome Powell has for us at 2 o'clock with the SEP summary of economic projections, as well as the press conference commentary, and of course Q&A. So I hope to see you there at that element, at that time, at that event, at that whatever. It's been a long day. So hopefully I'll see you there. Hopefully have a green trading week. And as always, hopefully I'll see you in the next one.